What's up guys, my name's Adrian and welcome to another episode of my monthly video series where I present to you my TSX listed dividend stock picks of the month. So yes, the market has recovered significantly since the crash in March, but another little dip is happening right now due to the spiking COVID-19 cases in the US, especially in those gun-loving states like Texas and Florida. So there are still plenty of heavily discounted stocks out there ready to be snatched up by income investors like ourselves. So just a quick disclaimer before I unveil my picks for July. I am not a certified financial advisor or have any financial background whatsoever. I've been investing in the stock market on my own since about 2012 and own a dividend stock portfolio of about $600,000, which generates about $1,000 a week in passive income. So I definitely consider myself an income investor, and my investment strategy exclusively deals with dividend paying stocks. So my monthly picks will consist of dividend stocks, which I feel are a great value right now. So let's get started with the picks. Alright, so pick number one is one of my favorite ETFs of all time. It's the BMO Canadian High Dividend Covered Call ETF, so stock symbol ZWC. So in this ETF, you have a portfolio of about 35 Canadian blue chip, really big cap, dividend paying corporations, the best of the best in Canada. So you're diversified across numerous sectors, and in order to generate a higher distribution yield or dividend yield, BMO uses the covered call strategy. So if we look at the prices now, the 1 year high price for this stock was $19.43, which gave an annual yield of 6.79%. Not bad, but right now heavily discounted. It's $14.72, which gives an annual yield of just under 9%, which is great. So my reasoning and takeaway for this one, it's a very attractive dividend yield for really a sector diversified ETF here. You're getting the best dividend companies in Canada. And what's interesting is that the distributions or the dividends have increased every year since the ETF's inception without missing a single payment, which is very reassuring. So in summary, investing in this ETF gives you almost 9% annual yield. It's a no-brainer. It's the best way to get broad exposure to the biggest and most reliable Canadian companies, including the legendary Big Six Canadian banks, which makes up about 22.5% of the ETF. And there's other legends in there like Enbridge, TC Energy, Bell, TELUS, Manulife, Sun Life, etc. So let's check out the fund's website real quick just so you could piece together what I'm saying here. So real quick, I just want to take a look at the holdings of ZWC here. So you have a lot of the Canadian legends. You have CIBC, Bank of Nova Scotia, Enbridge, Manulife, BCE, and all a bunch of just really the best of the best when it comes to Canadian companies. Some utilities in there, really good utilities like Fortis, Emera, etc., etc. So if we look at the distributions, I'll show you what I meant that they're increasing. So if we look at the 2017 distributions, you could see that monthly they're about a little over 10 cents a month. Then if you go to 2018, they get really stable at 10.5 cents a month. 2019 it increases to 11 cents, and then in 2020 we're still at 11 cents. So it is increasing slowly, but the reassuring part is one, they never miss a month, and two, it is increasing, which is great. So pick number two is another covered call ETF that BMO offers. It's the BMO covered call US Banks ETF. So stock symbol is ZWK. So this ETF holds a portfolio of 14 blue chip dividend paying US banks. And in order to generate a higher distribution yield, just like pick number one, they use a covered call strategy. So if we look at the 1 year high price, it's $33.11, which gave a dividend annual yield of 6.52. If you look right now, very heavily discounted, the price is about $20.90. So it's giving a distribution yield or dividend yield of over 10%, which is just insane. So my reasoning and takeaway, US banks are at a steep discount right now because of COVID-19. I would say even more so than the Canadian banks. US banks are also a lot safer investments post the 2008 financial crisis. And this ETF actually gave 4 dividend increases in less than 2 years, and they have not missed a single payment, just like the first ETF. So why are US banks much safer? Well, it's because they passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was passed in response to the 2008 Great Recession, or the financial crisis. So in short, this act says that they can't use as much leverage as before, so they can't borrow as much money as before, making them much less risky banks. So with a high yield of 10% plus, because of the recent decline and those covered calls that really boost the dividend, this is really a no-brainer. It provides an easy and safe way for us Canadians to access this powerful and lucrative US banking industry. So let's check out the fund page real quick right now. So let's look at the holdings real quick. There's 14 of them, and they're all pretty much the biggest banks in the US right now. So you have names like Citigroup, of course, Bank of America, JP Morgan and Chase, Wells Fargo, etc., etc. Let's check out the more interesting factor, which is the distribution. So this ETF came out in 2019, and if we look at the monthly dividend breakdown here, you could see it started 13 cents, then it jumped to 14 and a half, 15 and a half, 16 at the end of 2019, and starting in 2020, 18, back to 16 in February, but right now it's holding pretty good at 18 cents, including the latest one that just came out last week. So a really nice dividend increases here. Combine that with the decline and the value of this stock with a great yield, it's really a no-brainer if you ask me. So stock pick number 3 is PROREIT. Stock symbol is PRV.UN. So this is a Canadian real estate investment trust, or a REIT, that owns a diversified portfolio of high quality commercial properties. So commercial properties can be industrial, office, and retail properties. It was founded in 2013. And is present in 9 Canadian provinces with a strong focus on Eastern and Central Canada. So if we look at the prices right now, the 1-year high of $7.85 was giving a dividend yield of a little over 8%, but right now a really big discount. It's at $4.26 and it's giving a dividend yield of over 10%, which is huge. So my reasoning and takeaway for this one is that this REIT recently graduated to the TSX from the TSX Venture in mid-2019, which is a good sign. Many of their retail tenants are essential services like grocery and pharmacies, which is good. The yield, or the dividend yield, is over 10% right now, and that's even with the recent dividend reduction of 30% that they did. For the April rents, 92.3% of the rents were received, 97.4% if you include deferrals, which is pretty high. And they recently released their Q1 2020 results, and they were very positive. So in summary, many commercial REITs have taken a huge hit because of COVID-19. This REIT is no exception. It's really because of the retail companies. So in my opinion, I highly doubt a further dividend decrease will occur, making this heavily discounted REIT with a over 10% yield a perfect entry point for income investors if you're interested in investing in real estate in Canada. So let's check out the 2 articles that I referred to here. So this is the statement that they provided explaining the dividend decrease. So the CEO says that they decided to revise our distribution policy in order to lower both our payout ratio and debt ratio. It's a prudent approach that we believe will prove to be a historical opportunity for the use of our capital. Unit holders should be rewarded going forward, as our stronger profile will enable us to allocate capital towards accretive initiatives. This more conservative financial structure is also likely to attract a broader investor base. So they'll go on to say that we've also suspended our DRIP program, as we do not think it is in the best interest of the REIT nor its unit holders, which is us, to issue units at current market prices, which key point here, which have fallen to a significant discount to NAV in the COVID-19 environment. So they're basically saying that the shares are very heavily discounted compared to the NAV, or the net asset value. So it's good. It just means the stocks are cheap. And if we look at the most recent announcement in May 13 about their Q1 results, it's all positive. You have a lot of increases here: 31% a year-over-year increase in property revenue, 22% year-over-year increase in net operating income, etc., etc. So you can go ahead and read the articles yourselves. The link is basically in the presentation. So this further proves that this REIT is really well managed. They know what they're doing, and the dividend reduction was pretty much warranted, and I do not see any further dividend reduction for the foreseeable future, which is a really good thing for this REIT because you're getting 10% yield if you buy it right now. So my fourth and final pick for this month is Alaris Royalty. Stock symbol is AD. So Alaris provides financing solutions to well-established private companies in North America, and in exchange they receive a stream of monthly cash distributions or royalties, which they pass along to their shareholders, which is us, in the form of dividends. So their goal is to continue to diversify and increase revenue streams by adding a select few new partners each year. So if we look at the prices now, the 1-year high price for this stock was $23.84, giving a dividend yield of 6.98%. But right now, very heavily discounted at about $12.17, which is giving you an annual dividend yield of 9.53%. So my reasoning and takeaway for this pick is that the company's objective, or the whole point of their existence, is to provide dividends to shareholders. This is always great news for income investors like us. They did recently reduce their dividend by 30% as a precaution for COVID-19, and they also switched to a quarterly dividend instead of monthly. And on June 22nd, they released an interesting statement. I would strongly advise reading the statement underlined here if you're interested in investing in this company. So they advise that the COVID-19 impact has been less severe than anticipated for their partners, and that they are converting the company from a corporation to an income trust, which is great for us income investors. So in summary, with a yield of over 9%, and this is after the dividend reduction, as well as the recent announcement, this is really a good entry point for income investors because we're going to lock in a really high yield of over 9%, and there's very strong potential for share price appreciation as well here. So really a win-win if you ask me. And there you have it, guys. Those are my picks for the month of July 2020. As usual, you could download the presentation for free. Just check out the video description below for the link. So please let me know if you agree or disagree with any of my picks this month, or have any dividend picks of your own you want to share that are listed on the TSX, on the Canadian exchange. I will be more than happy to check them out and provide my opinion. So finally, please make sure you subscribe, guys, and click on the little bell next to the subscribe button so you don't miss out on my stock picks for next month, as well as my other investment videos. So take care, guys, and see you next time.